I'll speak, and then Matt will introduce you. Hello. All right, good evening, everyone. Thank you so much for coming. I'm Destiny Coleman, Director of the Woltemade Center for Economics, Business, and Entrepreneurship, and I'd like to welcome you to the Economic Outlook Conference. This evening's event is sponsored by the Department of Economics and Business and the Woltemade Center. The Woltemade Center's mission is to enhance academic programs and provide real-world opportunities to create future business and world leaders. Inspired by the work of late Dr. Uwe Woltemade, Professor of Economics at Ohio Wesleyan University from 1965 to 1995, the Woltemade Center was established in 1985. Grants and gifts from the Cleveland Foundation, the Ford Motor Company Fund, alumni, and friends provided the startup funds for the center. Since its founding, the center has received support from foundations, individuals, alumni, and corporate partners. I would now like to welcome Matt Volrath, Faculty Director of the Woltemade Center, Associate Professor of Business Administration, and Chair of the Economics and Business Department.
Hi, everybody. Thank you for being here tonight. I am here to introduce our event moderator, Dr. Goran Skosples, who joined the Ohio Wesleyan faculty in 2006. His teaching focus includes economics of transition, macroeconomics, development economics, international economics, research methods, and economic principles. His research deals with institutional changes in post-communist countries of Eastern Europe and the former Soviet Union, banking and credit, and small business finance. He earned his bachelor's degree from Lake Forest College and both his master's and doctoral degrees from the University of Illinois, Urbana-Champaign. Goran, thanks so much.
Well, thank you all for coming tonight. I can say that we definitely live in interesting times. The economy has been turned on its head, whether you're looking at our national economy, Central Ohio economy, or even the global economy. Economic policies have been used in unconventional ways. Our traditional understanding of how the economy works has been challenged, and the future seems uncertain. As a scientist, I'm kind of excited about all the disruptions that has been done, because that's never been done to the scale in history. As a participant in the economy, however, I'm not excited at all. I'm actually a bit scared about what might come out from all of this disruption around us. To shed some light about where we are and where we are going, we will have three distinguished guests tonight present to us their thoughts and views. So let me briefly introduce them. You have their bios in the brochure, so I will add a few details. So Bill LaFayette is going to present on the national or on the Central Ohio economy, regional economy, and he's the owner of Regionomics. He's been the owner and founder of Regionomics since 2011. He understands trends and is able to organize, simplify complex ideas. He understands economic and community development. He possesses an often hard-to-find skill set in taking complex data sets for analysis, and he enables organizations and groups to be able to clearly set directions and mobilize implementation. He provides a quarterly Ohio economic update for the Ohio Realtors. He provides Columbus Economic Forecast, which is released annually in early January. We're looking forward to that. He also publishes a series of bi-monthly articles for Hannah News Service exploring various aspects of the Ohio economy. You can hear him often on NPR giving talks on the local Ohio economy. Ian Sheldon from Ohio State University is going to present to us about the international economy. Oh, there's a lot going on in the trade, right? So I'm really looking forward to hearing what's going on. His primary research interests are analyzing international trade and policy. Recently, he's been examining impact of COVID-19 on global disruption in terms of trade and impact on the Ohio economy. He received a Ph.D. in economics from the University of Salford in the UK and moved into Central Ohio in 1990. So he's been with us for 35 years at Ohio State. Very good. So I'm really looking forward to hearing what he has to say. Willem van Zandweghe is Vice President of Research Development at the Federal Reserve Bank of Cleveland. He oversees research, and his research focus is on business fluctuations, inflation dynamics, monetary policy, everything that my students in national income and business cycles hear about daily and follow daily. So we're going to hear it firsthand, what an expert in this field, not fraud like me. We're going to hear it from the expert. His most recent work actually analyzed an appropriate monetary policy response to shocks in the labor market, which seem very useful, and it's going to be very important to hear, given that a lot of you are going to join the labor force, perhaps even as early as this May. Willem comes to us from Belgium originally, and I hear that he's very good at making Belgian waffles. So we're going to start with Ian and move on to the national economy with Willem, and then conclude with Bill. After that, we are going to open the floor to the audience for some questions. Thank you for coming tonight, and please join. Welcome, Ian.
Thanks very much, Goran. Thanks for inviting me up here once again. I guess I must have done a good job at some point in the past. I've been an economist for 43 years, and I never thought I'd be talking about trade wars twice in the latter stages of my career. So I think I came up here during the 2018-2019 trade war, and I'm mostly going to talk about US trade policy tonight, because I think that's probably what's on most people's minds. It's what I'm spending most of my time talking about. I'm getting tired of talking to the media. I've done over 75 media interviews since February, April, so it's getting tough to think of anything new to say about what's going on. But basically, if you wake up every day, read the New York Times, I sometimes think I'm reading the front page of The Onion, because it's something strange has happened that day as regards trade policy and other policies. So I'm going to do three things. We have a very short amount of time. I'm going to talk about where we are with tariffs. Some of you probably know this, but it's just a good place to update. Secondly, I'm going to talk about the legal situation in relation to tariffs. As a side event, I did earn a modest law degree at Ohio State. I'm not a JD, but I know enough law to be dangerous. And I'm going to give you my forecast of what I think the Supreme Court is going to do. And if you invite me back next year, you can tell me whether I got it right or wrong. And then I'll talk about the impact of where we are with tariffs on the US economy. And I'm not going to talk about the impact on prices. I think we're still waiting to see the full effect of tariffs on prices. But I'll leave it to Willem to talk about where we are with inflation, because that's more his bailiwick, coming from the Federal Reserve. So, this want to work? Okay, we'll just... So this is, think of me as Jimi Hendrix or a guitarist that you might remember. My string just broke, and I'm getting my roadie to fix it for me over here. So I'll.
That was it. This is just one page. Oh, I'm sorry.
How many economists does it take to put PowerPoint slides up on the screen? Thank you. Yeah. So I get a few more minutes, right?
Yeah. I don't know how to start the presentation.
Okay. Thanks very much. So this is, today I actually gave another Outlook talk down on campus. It was mostly about agriculture, because I'm an agricultural economist by training and specialism. But I'm going to broaden this out today in my latter parts of my presentation. But let's talk first of all about The current position on tariffs, I'll give you a graphic in a minute. So you'll all remember Liberation Day on April the 2nd when the first round of tariffs were implemented. And these were pretty much set in place, more or less, this past August. And right now, the Yale Budget Lab numbers, the most up-to-date numbers, show that the US's average effective tariff, so that would be averaged across all countries, across all goods, across all sectors, that's actually a little bit lower than 17.9% because their latest report came out 24 hours ago and I hadn't had a chance to update. It's down to about 16.8, around about 17%. But the point is, these are the highest tariffs still since the period just after the Smoot-Hawley tariffs were introduced in 1930. And I just want to make a side point is the Smoot-Hawley tariff, where tariffs were anywhere about 35, 40% on average. Those tariffs were the last time that the US Congress actually set tariffs on every good imported into the United States. And Congress has never actually spent that much time playing around with tariffs as they did with the Smoot-Hawley tariff. And a lot of Congress gave more authority to the president or the executive branch of government to implement things like trade agreements and discussions about tariffs. But the legal issue we'll come to in a minute as to how much of that authority was passed over to the executive. So back in April, 10% tariffs were implemented across all countries. That was a baseline. And then reciprocal tariffs were implemented against all of our trading partners with whom we had large bilateral trade deficits. I'm not going to comment on the formula that was used. I think most of us, I'm sure Willem, probably Goran and maybe everybody here on the panel sat around on their backs waving their legs and arms in the air laughing at this formula. It's been heavily criticized by the economics profession, but in a sense that's irrelevant because these were the tariffs that were implemented and what we have to play around with. So the only thing I can say is that with the United States, Mexico, Canada Free Trade Agreement, which is an important trade agreement, particularly to the agricultural sector, which is where I work. Right now, most of those tariffs, bar the tariffs on aluminum, steel, and automobiles, are pretty much set very low as long as the import or the traded goods meet the USMCA, what are called rules of origin. There have been a number of, I wouldn't call them agreements, they're deals. They're fairly, I would say, superficial, not particularly widespread in terms of their terms, but deals have been signed with countries like the United Kingdom, the European Union, and most recently with China. So this graphic here, there's a lot of color on that diagram. There's really one along the horizontal axis. That's most of the countries whom we've set tariffs against. And the point to be taken away from this, these were uniform tariffs of 10%, but only a few countries right on the right-hand side of the graph, including the UK, face 10% tariffs, all the way over to the left-hand side where Brazil and India are facing tariffs of about 50%. In the case of Brazil, you'll notice I've put a blue bar on the red bar. That's to account for the fact that the administration chose to penalize Brazil because they didn't like the fact that former President Bolsonaro is going to be sent to jail for having fomented a coup when he lost the last election in Brazil. We can talk about why that's a very transactional reason for putting a tariff in place. And then India, the green bar relates to the fact that Prime Minister Modi has refused to stop importing oil from Russia. The yellow bars relate to the countries China, Mexico, and Canada, where tariffs were applied in order to prevent or to force countries to stop fentanyl coming into the United States. And then the blue bars, they refer to the countries where we've established free trade agreements. So the 2 points to take away from this, the United States has violated two of its major commitments to the WTO. One, it's unilaterally set tariffs against pretty much all of its trading partners. So that's the first. The second is that these tariffs are highly discriminatory. We go from 51% all the way through 30, through 15, through 10. If you know anything about the WTO, one of the pillars of the WTO, the World Trade Organization, and its predecessor, the GATT, is that we don't discriminate against our trading partners if we agree on a bound tariff in trade negotiations. So it's highly discriminatory what the administration has been doing. The legal authority, so the administration would appeal to the 1977, it's a long-winded act, IEPA, I'm going to say for short, is the acronym. It gave the president authority to regulate trade via embargoes and sanctions if there was a major issue of national security. Typically, up to that act, this act has been used for precisely what it sounds like it was designed to be used for. Jimmy Carter, when he was president, used this act to implement sanctions against Iran. And more recently, both President Biden and probably President Trump have implemented sanctions against Russia using this act. So this is the first time this act has been used to implement tariffs. You'll notice the words that the lawyers are arguing about is regulate, embargoes and sanctions, and national emergency. The big issue is tariffs were never mentioned in that act, and there's no definition of a national emergency. The claim is that the trade deficit the United States is running is a national emergency. Just to remind you, we've been running a trade deficit since the late 1970s, and suddenly it's an emergency. Just to give you the first court that examined this, the Court of International Trade, it's a very obscure court, ruled 3-0. There are 3 judges on the panel. They ruled that this was the president was exceeding his authority by setting these tariffs. The administration appealed. There was a stay put on the original ruling. The appeals court then ruled 7-4 again against the administration that these tariffs went beyond the authority allowed under this act. And now it's gone to the Supreme Court, and we had oral arguments on the 5th of November. I don't normally make forecasts in this presentation, but I am going to make a forecast tonight, and that is prior to the oral hearings, I would have predicted that the court would punt on this by allowing the president to keep the tariffs but sending it back to Congress, because Congress has constitutional authority to set tariffs, if you know your Constitution. Here am I, a Brit, telling you about the American Constitution. I did pass my citizenship test. So prior to the oral arguments made me change my mind, and Paul Krugman had a great graphic, which I don't have in my slides today. The forecast market showed that the expectation that the court would rule in favor of President Trump went from 40% to 26% overnight after the hearings. So my forecast now is that the Supreme Court will do 2 things. They will rule against the tariffs 5-4. I think Justice Roberts and Justice Coney Barrett will rule against the tariffs, along with the 3, quote, liberal members of the court. But on the other hand, what will happen is they'll say, as of this date, you can't set tariffs anymore, but they'll also argue you don't have to return the tariff revenue that you've raised so far. And the reason I make that argument is Justice Coney Barrett made it very clear she thought it was going to be a big mess handing back all the tariff revenue. So if I got it right, I shall go off into the sunset and say, wow, I got it right. As a trade economist, I know what I want to happen. So let me talk now about the impact of tariffs. I've got about, 4 or 5 minutes. We'll do this quickly. So I've already said this. The current policy is just a significant rejection by the United States of the multilateral trading system that it helped to build. The GATT, formed in 1947, was largely driven by the United States in combination with, particularly with European trading partners. So the expectation is we'll see a decline in real GDP growth, and there's going to be deadweight losses to the US economy. We already know from the 2018-2019 trade war that just on a basis of 1 year's data, 2 of the most cited studies showed about $8 billion worth of deadweight losses. Tariffs, of course, are a very regressive tax, so most of the burden of tariffs is going to fall on people at the lower end of the income distribution. We're going to see continued reallocation of global value chains. We've already seen that. You have to understand that this is a significant additional cost to the economy. Firms have to spend money on search costs and matching costs in seeking out new partners to trade intermediate goods. And we're going to see all kinds of problems to do with transshipment. For example, China is now producing goods in Vietnam as a way of getting around the US tariffs against China. There are going to be debates about the rules of origin that are going to be rather complex. In terms of agriculture, which is mostly what I spend my time thinking and talking about, US agricultural exports have been explicitly targeted both in the previous trade war, where the US lost a lot of market share to Brazil, particularly in the soybean industry. The soybeans are China's the biggest market in the world for soybeans. It's the #1 export out of the state of Ohio. The soybean industry has spent years developing that market in China and other parts of Southeast Asia. The numbers here are pretty clear. There's been a 73% decline just over the January-July period in the value of our agricultural exports to China, with soybeans being particularly hard hit. Notice that only goes up to July because we don't have the most recent data because of the government shutdown. We should have received that data. We hope to get it in the next few weeks. So that's the effect on GDP. This is from the Yale Budget Lab. You'll see a pretty significant decline in terms of the rate of growth, and then the economy recovers. Remember, these tariffs are a one-time shock to the US economy. I don't know whether Willem would agree with those kinds of numbers, but this is what the Yale Budget Lab is forecasting. This is what they suggest is going to happen to GDP growth around the world. You see the US is coming out of that the worst. This is showing you how regressive tariffs are. This is the first to the 10th decile of the income distribution. You can see consumers at the lower end of the distribution stand to lose the most from tariffs. So this is well understood that people on lower incomes tend to purchase more traded goods as a share of their income than do people at the higher end of the income distribution. This was the value of lost exports to China that we know about so far. The thing to see there is $3 billion worth of trade lost for the soybean sector, and we haven't managed to make it up with exports to the rest of the world. Interestingly, the corn industry has not been as nearly badly hurt, and they've managed to increase their exports to the rest of the world. So I did have a couple of more slides, but I'm going to finish there. I was going to briefly mention that the dollar has depreciated, which goes entirely against what traditional open economy, flexible exchange rate models, i.e. the open economy, the Mundell-Fleming result that would suggest that with high tariffs, you would see an appreciation of the dollar, and we can talk about that later. But we've seen a depreciation this time around, and that's Bank of England economists think that's mostly driven by the threat of retaliation, but also the bond vigilantes out on the international market pulled out of a lot of American investments after the trade war began. And if you pull out your funds out of treasuries, if you're a foreign investor, you're selling an asset that's denominated in dollars. So if you're selling a dollar-denominated asset, that pushes downward pressure on the currency. The other thing I was going to talk about, and I'll be very happy to visit with folks about that as we move on through questions, and that is a member of President Trump's cabinet, who shall remain nameless. You can ask me later in questions if you want. He's not an international economist, but he is the advisor on international economics. I'm being suitably sarcastic here. They have forecast that we could raise at least $600 billion in tariff revenue. Every macroeconomist that I've read here suggests that this is very unlikely, and it's interesting that LAFA has come back into fashion. There are LAFA tariff curves. LAFA tariff curves show that you can raise a tax to a certain point, and if you keep raising it, eventually the revenue starts going down. So think about a tax on imports. What does it do to the demand for imports? The higher you raise it, you move back up the demand curve, and you start squeezing down the amount of tariff revenue. So the estimates I've seen from economists, Simon Evenett, who's an economist in Switzerland, and his colleague, is that we're not going to be able to raise above $500 billion, and their results are very dependent on how much of the tax revenue gets put back into the economy and is not saved. In other words, you don't want the trade deficit to decline too much as you raise tariffs. Otherwise, the tariff revenue goes down, and you just start to increase the deadweight losses. So thanks very much.
Yeah. Thank you, Goran. I'm really pleased to be here. Thank you for the invitation. I always have to start up saying that what I'm presenting are my own views and not necessarily the views of the Federal Reserve Bank of Cleveland. So I always have to start off with such an unpleasant announcement. But really what I want to do today is take my time to talk about national economic conditions, where the economy is today, this year, more generally, and then also from there what we can expect for the next year or two. I do want to kind of start by motivating a little bit and talking about why we might care about the economic outlook. It's a very dry subject. Often, if you're not an investor, you might say, why do I need to know what's going to happen in the economy? So, but from the Fed, at the Fed, it's a very sort of very important, very direct issue for us to have a careful assessment about the macroeconomic outlook, because it directly plays into the Fed's dual mandate. So the dual mandate for the Fed is to promote maximum employment and price stability. So when it comes to maximum employment, and this is something probably everyone is kind of aware of, that the cost of unemployment, so people who are unemployed, they lose income not just while they're unemployed. Often it's something that affects your career path. There's also the stress, so the time that you're looking for a job, you don't know when you're going to get a job. So this is all very painful. And times of recession is times when there's just a lot of people who are unemployed, and then everybody looking for the few jobs that are there is going to make it that much harder and more stressful. So this is something, these fluctuations and kind of times of high unemployment is something we want to, or is the mandate for the Fed is that to try to like smoothen out those fluctuations. On the other side of the mandate, and this is really the kind of the pillar where once you get is this price stability. So once you get that right, you can start thinking about employment. But so inflation is something we've all kind of been through in the last few years. It was very interesting for me, having studied inflation for, say, a couple decades, but it was always very abstract even for me. But so when you have to live through it, you really, I think everybody sort of realized, I really hate this, always seeing prices going up, and whenever you go to the groceries, mostly where you're facing it. But really overall, it means whatever your income is, you can buy less stuff with it. So that is what people definitely don't like. But more generally, what it also does in the economy is it creates all kind of distortions. So demand distortions, because firms, profit maximizing firms, it's crucial that they set the right price. And it becomes that much harder when the price level keeps changing to get the price right, because firms cannot continually change the price. Their customers don't like it. There is information friction. You have to spend a lot of time, resources, meetings just to try to keep up with that. So that creates distortions. And then there is this sort of redistribution, because a lot of contracts are written in dollar terms, a redistribution from creditors to debtors. So if you have a mortgage, then some surprise inflation will sort of erode you still owe the same amount of dollars. It's just that they're easier to get. It's not so costly anymore. For the government, this is also when you have the government has a lot of outstanding debt, which also now is reduced by inflation. So if you owe money in dollars, it's good. But if you have a claim, if you are the bond holder, this will surprise inflation will reduce the value of that bond. So this kind of redistribution is a cost, and those costs get only higher when inflation is higher, because we know that high inflation is associated with inflation being more volatile, and in particular those unexpected surprises that are that much more costly. So that's kind of just to motivate why we might want to follow what's going on with inflation and employment. I also want to kind of say that this is for the Feds, because the Fed's in the news a lot. So right nowadays, so the Congress has given the Fed this narrow mandate to, as I said, focus on or promote stable prices and maximum employment. There are many other macroeconomic issues that are very important, and particularly you might think about inequality, poverty, and this kind of redistribution there. So these are issues that are very important, but they're outside of the purview of monetary policy. So they're the domain of fiscal policy. These are things that it's appropriate that elected officials decide about this. And moreover, the Fed's policy instrument is really setting short-term interest rates, and that's really not wouldn't be an effective tool to address this kind of redistribution issues. Okay, with all that said, let me jump into kind of what I wanted to talk about really. So this is a kind of on three parts. So there's the economic growth that's been moderating, but is expected to remain steady for the next year or so. We've seen, in particular in the last years, that consumer spending has been very resilient, and it continues to be a pillar for the growth, even in the outlook. At the same time, business investment has been strong the first half of the year. That may temper, but it is still there as a kind of a driver of growth. So that's kind of a positive picture. In the labor market, unemployment is also, things look overall healthy. Unemployment is still low, but broader labor market conditions have cooled. So I'll talk a bit about that. Job growth has really kind of stalled very, very sharply. Firms are now in a position where they're not firing people, or not generally. We don't see an increase in layoffs, but also there's not a lot of hiring going on. And all this kind of increases the downside risk. So it's sort of a risk that if there is a shock, then given that firms are not hiring, and if they start laying off, you could suddenly see an uptick in unemployment. So there's a question, especially for monetary policymakers, is a big question, is how vulnerable is the labor market really? And that's set against kind of the price mandate, where we've gone through this period of high inflation in the aftermath of COVID, and inflation has been going definitely in the right direction, but this year inflation is kind of turned up again. So this is now also on the forefront of people's minds, clearly this increase in inflation is now related to the tariffs, but to what extent is this just one-time price increase, or is there more still lingering broader inflation pressures? And that kind of is where the issues for monetary policy, which has in the last couple of months lowered its policy rate, the federal funds rate, trying to take a balanced approach to lean down on the still high or rising inflation, but also not trying to lean too hard, because we want to provide support for the labor market as well. So let me walk through and try to speed up here. But so GDP growth, you see here, you can kind of see in the recent years has been coming down a little bit, but has stabilized around what we think of as its trend line. So we're looking at something like 1.8% annually, and that's the little bit below that is where the forecasts are right now. So this is not an economy that's booming, but it's also not an economy that's in recession. It's just sort of a stable trend rate. A key driver of GDP growth, of output growth, is consumer spending. Simply, you can think of it as consumer spending accounts for about 70% of GDP. So what happens with consumer is going to have a huge impact there. This chart here shows the contributions to GDP growth of both goods and services spending. Services spending is typically the larger component, and also over time grows faster. So the blue bars tend to dominate here. You see also the orange bars for goods kind of more fluctuate more. And so we've seen in the first half of the year, those last two bars, goods spending is kind of dried up pretty much. Could be related to the tariff increases there. That's going to have a bigger impact on goods. But at the same time, you notice that these orange bars are pretty volatile, so it's not really directly evident that this is related to tariffs only. The good part is, the positive part is that the blue bars continue to be solid, so this services spending continues to be a pillar for growth. And forecasters also estimate that consumption growth was strong actually in the last quarter and will continue to be solid for the next year. For firms, investment spending, that has in the first half of the year, those last two bars, has really jumped. This is driven by increases in IT, computer equipment spending, and software spending. That could be related. So it could be, is probably likely related to the AI boom, these investments. But there is also a part where in the first half of the year, the increases in tariffs made firms want to front-run tariffs. So there was these announcements, and firms put in their orders to avoid tariffs. So there's these two effects are pushing up investment in the first half. And so what forecasters are expecting is that investment is coming down actually right now in the second half of the year, as these tariff effects kind of that's the backside of it. So the spending has been done. So it's going to slow down there. Moving on quick. So I wanted to say something also on the kind of you hear maybe about the K-shaped economy. There's a fragility here in that consumer spending, household spending has been focusing more and more, coming more and more from high-income households. So this is what you see here in terms of wage growth. So the blue line is wage growth of the lower income workers, and that was very strong after the pandemic, but has really dropped a lot now, whereas wage growth for the higher incomes has been stable. So the same kind of bifurcation or pattern we see also in terms of consumer confidence, income expectations. So this sort of spending has become reliant on a smaller group of people, and that is sort of suggests a fragility there. We also see this, aside from steady growth in labor earnings, you see spending by wealthier households being supported by strong high net worth. So there's some really striking statistics when you look at real estate equity as a percent of disposable income is higher now than at the peak of the housing market bubble in 2005. Also, the stock markets, corporate equities as a percent of disposable income are higher, much higher now than at the peak of the tech bubble in 2000. And then money mutual funds as a share of disposable income, again, as large now as at the previous record high in the financial crisis. So all this wealth boosts confidence for those households, at least, who can participate in it. Let me talk a little bit about the labor market. So the striking thing this summer was that job growth, which was actually surprisingly strong in the beginning of the year, has really come down to practically zero. That's kind of a concerning picture when you see that typically, the recession alarm bells start ringing. But there is kind of a mitigating factor, which is that also with immigration clampdown, so there's both labor supply and labor demand that have come down. And so that doesn't necessarily signal there that a recession is imminent. So you see so employment is basically not growing anymore, and you see also both in terms of the turnover, hiring has come down a lot, whereas layoffs thankfully remain low. And so there's really this kind of curious stagnant labor market conditions where things are good, especially if you have a job, you're unlikely to, not particularly likely to lose it, but it's very difficult to find a job. So with that kind of stagnant labor market, the unemployment rate has ticked up, but it remains low. So it's actually been pretty flat. You see that the blue line is now at 4.3%, is our latest number for August. Forecasters expect this to tick up to 4.5% and kind of hang there for the next year. So again, kind of consistent with steady growth, no recession, but some downside risks. And so that's kind of the picture of the labor market, and the big question hanging there is how concerning is this slowing in hiring? So on the inflation side, we've seen a substantial decline. You see there 2021 and 22, that was the big inflation peak. Then that has been brought under control, but not quite where the Fed aims to get it, is 2%. And so it's been a little bit above 2% by the beginning of this year, and now it's been coming up again. And so these dots there are the forecasts for the next year or so. As forecasters are expecting inflation to head back in the wrong direction for some time, for temporarily. And in terms of how the tariffs weigh on this, we can drill down a little bit in the goods and services components. And so this blue line here is the goods inflation. Actually, goods inflation is typically around 0, so goods prices don't really rise on average, but those have been turning up to about 1%, so that's you expect to see the impact of tariffs most directly. That purple line, that is services except for housing, that's also been kind of flat, so that's maybe where you would say, how come this is not coming down more? We don't expect tariffs to play much of a role there, so that's where some people who are concerned about inflation would be most concerned about. And then the orange line is housing inflation, which has come down very slowly, but is still heading in the right direction. So I think it's time to wrap up here. Maybe if I can take very quickly, kind of to tie it back to monetary policy. So this is the federal funds rates come down. So as I mentioned, the committee that sets the rates have brought the rates down closer to a neutral setting, and this is to sort of trying to balance the risks of that they want to bring rates low enough to support the labor market, but also not too low so that inflation, that there continues to be a little bit of pressure down on inflation. Yeah, so let me just stop here. Mm-hmm.
Well, hello, everybody, and thanks a lot to Goran and the Walter Matthey Center and the department for having me back again. I've got 3 topics tonight. I'm going to talk about economic statistics as applied to the local area, which is going to turn out to be a cautionary tale. Then I'll talk about our region's population growth, and finally, a topic that might be of passing interest to the students in the room, the potential impacts of artificial intelligence on the job market. So I have a favorite saying about economic statistics. Timely statistics are not reliable, reliable statistics are not timely. And this came in to bite me hard this past January when I released my 26th annual economic forecast for Central Ohio. I need to start, though, by defining Central Ohio. This is the 10-county Columbus Metropolitan Statistical Area, or MSA. Now, MSAs are defined based on worker commuting patterns. And so an MSA is a meaningful economic unit, and it's the unit that I usually analyze. Now, I've always based my forecast on the current employment statistics from the Bureau of Labor Statistics. Those estimates are really handy because they're generally released only a month after the fact. So I have generally, when I do my forecast, I have estimates through the previous October, but they are not very reliable. And I recognize that the numbers are tentative, so I adjust the numbers that I think are off before I do my forecast. And those numbers are revised for the past few years every March. And that happened with this year's forecast. The preliminary numbers that the BLS put out showed 2024 employment growth in the Columbus MSA of 0.2% compared to 1.7% for the US. And I said to myself, that cannot possibly be right. And so I bumped some of the estimates upward, and I wound up with 0.5% growth, and that's what I based my forecast on. And as you can imagine, the forecast release event at the Metropolitan Club in early January was not a very cheerful affair. Add to that, I was coming down with COVID. But the March revisions moved our growth up to 1.2%, and the U.S. growth down to 1.1%. So here are the trends, the employment trends measured with a different series. This is the quarterly census of employment and wages. This has the great at this point of only being available through last March. And as you can see, the blue line is the Columbus MSA, the black line is the US, and the purple line is Ohio. We were growing faster than average coming out of the pandemic. Our growth slowed rather seriously in 2022, but since then we've returned to our winning ways. We were up nearly 1.3% year over year in 24 years. The problem in that sector is insurance, which has been in double-digit decline since 2022. That could be part of the reason for our weakness in the overall economy in 22. I'm paying a whole lot more attention to the quarterly census of employment and wages now. The problem is that none of those numbers are seasonally adjusted, so I have to do it myself, and that takes some time. So I'm in the process of that now for my 2026 forecast. Obviously, the first word out of my mouth is going to have to be oopsie, but we'll see. So my next topic is population growth. There is no doubt that our growth in the metropolitan area has been far above average. This chart compares growth in the Columbus MSA, the US, and Ohio between 2000 and 2022, or 2024, I should say. The MSA is blue, the US is black, and Ohio is purple. And the purple dashed line there at the very bottom is what happens to Ohio growth when you pull the Columbus MSA out. The chart's on an index basis with everybody's population in 2000 set equal to 100. So what this is doing is comparing cumulative population growth since 2000 across all those geographies. Between 2000 and 2024, the Columbus MSA added more than 543,000 people, growth of 32%. Our 2024 population was 2.23 million. In 2000, which was when I started paying attention to this sort of thing, the current 10-county MSA was 1.68 million. U.S. population grew 20.5% compared to our 32%, and Ohio grew only 4.6%. Between 2000 and 2024, Ohio added fewer than 520,000 people. So outside of central Ohio, the state lost 23,500 net over the last 24 years. But here is something that worries me. This chart compares the drivers of annual average population growth over the 2010s and the 2020s through 2024 for the Columbus metro area. There are two primary components of population growth: natural change, which is births less deaths, and net migration, which is movers in, less movers out. I've broken net migration here down into two components. Movers to and from here within the U.S., and movers to and from here relative to other countries. Natural change is blue, domestic net migration is black, and international net migration is purple. During the 2010s, all three components were firing on all cylinders. Births less deaths contributed 12,000 per year. International net migration was 6,500 per year, and domestic net migration was 5,900 per year. But look what's happened since. Natural change has been down to 7,000 per year. No big surprise there. We're all getting older and more of us are dying. International net migration per year, though, has more than doubled, up to 15,400 per year through 2024. But domestic net migration has collapsed. Between 2020 and 2024, an average of 750 more people per year moved out of our region than moved in. Huge change from before the pandemic. Now, it is no secret that the U.S. has become less welcoming to people from other countries, and immigration quotas have been drastically cut. Unless we can turn domestic migration around, we're in for a period of much slower population growth than what we've seen in decades. My final topic is the potential workforce impacts of artificial intelligence. Now, I spend a lot of time thinking about workforce and skills and all that sort of thing. And of course, this has been very much top of mind for me. Now, let me give you a spoiler alert. Nobody really completely knows AI's full impact on the job market, although several reports project no widespread loss of jobs in the long run. Remember Keynes's saying, in the long run, we're all dead. For example, a Goldman Sachs study argues that 2/3 of jobs have some exposure to AI, but it's only partial for most jobs, 25 to 50% of all their job duties. These studies conclude that AI will assist more jobs than it'll replace. As an IBM report put it, AI won't replace people, but people who use AI will replace people who don't. The impact is not going to be evenly distributed. It's going to be heaviest in office-oriented and professional occupations. There will be little or no impact in construction or production. Production is most heavily impacted by ongoing automation, as has been the case for decades. Again, if these reports are right, you will have to be ready to work hand in glove with AI tools, but at least you'll be able to work. Studies have found that AI improves the performance of low-performing workers to a much greater extent than it does for high-performing ones. So AI helps to level the playing field and make jobs more secure. But a point that nobody seems to be thinking about is that with more people able to perform specific occupations, wages will decline, and so will the premium for top performers. However, a Forrester research report is a whole lot less encouraging. It says that AI will replace 2.4 million U.S. jobs by 2030. That's only 1.5% of the total, but it's going to be very heavily concentrated in scientific, professional, and especially legal jobs earning more than $90,000 a year. But there is a lot of hype surrounding AI. And people, including Forrester, may be overestimating its abilities. That suggests lots of layoffs when employers implement AI, some of which might be restored when they discover that AI isn't all it's cracked up to be. We're looking, though, in the meantime, at tremendous churn in the labor market in the nearer term. OSU professor Angus Fletcher argues that AI is successful in logic, but certainly not in common sense or imagination. And that could lead to disappointment of employers who try to push the tool too far. There will definitely be new occupations, including AI integration consultants, AI model trainers, and other occupations, making sure that workers are able to integrate effectively with AI. So my advice to you is to work with AI as much as you possibly can. The sad fact is that some people won't be as able to adapt to this new paradigm as you will be and may have to leave their positions. You could step in. You will need to retrain yourself, though, on an ongoing basis, continuously. If you can accomplish that, you'll be fine. And that is what I wanted to share.
All right, I have plenty of questions for the panelists. I do believe that other panelists also have questions for each other, but before we get there, I would like to see whether there are any questions from the floor. You have been patiently listening and jotting down notes, and maybe you have some questions for our audience members. So if you do, please raise your hand, and you'll have a microphone so you could be heard on the recording. Over here.
A question for Ian. On one of your graphs you have, and we hear an awful lot about what's happening to soybeans with China. On that one graph you have a $3 billion negative on soybeans, but you have a $3 billion positive on corn. Why are we concerned about it? They're the same farmers. One offsets the other in terms of income.
Well, of course, I'd expect my former mentor in Outreach and Extension, Dr. Lyons, to ask me a question along those lines. Remember that China has been the largest soybean market for a number of years as they've increased their consumption of animal protein, and they need to feed those hogs and poultry. So the issue here is we started losing market share with Brazil even before the first trade war. We managed to recoup some of that when China and the U.S. had an agreement called the China-U.S. Phase 1 Trade Agreement. But we've continued to lose market share. And remember, a lot of states, you think about the former governor, I think it was of Iowa, who pushed really hard to expand that market in China. I think the issue, the corn industry's done a significantly better job of diverting corn from the Chinese market, where we're also losing market share out to Brazil. But soybeans, China deliberately targeted soybeans. There's no doubt that they deliberately targeted that sector. And what we're seeing here, I think, is the forefront of China's diversification of its import supplies. And they've chosen soybeans as the one to move on first relative to corn. So Many farmers in the Midwest were Republican voters. They voted for both this Trump administration and the previous one. And we know that in the first trade war, a lot of jobs associated with agriculture were lost due to the first round of the trade wars. I think the Chinese picked soybeans, because it's important to, it's the number one export from Ohio by far. It's 3-4 times greater than our exports of corn. So this was strategic political targeting at the same time that they've been diversifying their import supplies. So yes, we've done well in the corn market, but the soybean market is the one that they deliberately targeted, I think. And I don't think that China's going to be able to meet those commitments of importing more either before the end of this year or even going into next year. So I'm pretty pessimistic about what's going to happen to our soybean market. The problem is that other countries in Southeast Asia don't have the rate of population growth that China had and the growth of protein consumption. So even though Ohio's number one and number two export markets for soybeans are Indonesia, Taiwan, and then Malaysia, China's now dropped to the 5th largest market. We can't make up what we've lost in the Chinese market, whereas the corn sectors are doing a lot better. So we're managing to sell corn all over the world, but not much to China at the moment.
But if we're talking about the same farmers.
Remember, in Ohio, they planted more beans this year in the state of Ohio than they did in the rest of the country. But I guess a lot of it's to do with soybeans are relatively easy to grow. They have lower input costs. A lot of farmers have invested in a soybean corn rotation here in the state. So yeah, you can substitute away to corn to some extent, but you still need to have that rotation, I think, both technically and in terms of volatility of margins. You know, I'm not an agronomist, so I can't really go any further than that. But right now, the soybean issue is huge to the farming community. They're looking for a $12 to $13 billion transfer from the federal government to make up for that lost market share. And that's mostly going to go to soybean farmers if we actually see it happening.
I have a question for Willem. As a fellow card-carrying economist, I think I know what your answer is going to be, and I would agree with it, but I'd love to hear your take on it. I want to ask a question about affordability. We go to the grocery store, and last year we would pay $4 a pound for hamburger, and now maybe it's $6. We hear the projections that the rate of inflation, the rate of price increase is going to slow. So maybe instead of $6 next year, it'll be $6.50. The rate of change has slowed, but darn it, hamburger's still really expensive. When people are, talking about affordability and wanting to see prices come down, is that at all realistic?
Yeah, no, I think you make a good point, because this is often a point of confusion, the inflation rate, the rate of change versus the price level. And a lot of times a lot of people would expect, okay, when inflation's done, we should see prices go back. And that's not what we should expect to see. How you expect this to kind of come to a closure is when your wages start also catching up. And this is sort of the interplay where we've seen inflation take off if you remember the chart, a strong period of inflation, and then later on wage growth caught up. But it's still going to be not satisfactory for a lot of people, because you typically feel, well, this inflation, that was something that happened to me, whereas the wage increase, I had to, make extra effort. I had to talk to my boss. It was very uncomfortable. I had to earn that wage increase, and that's I won't dispute it. But in the end, what you see, for instance, to take a very clear example, we saw this for new car prices increased about 20% since before everything started, since 2021, say. But wages have also increased 20%. So the amount of car you can buy is back to where it was. So I think that's how things balance out, but they won't balance out by seeing prices go back to where they were in
But-
most products.
But if the economy slows, then wage growth should be less common, right?
Yeah.
So we could be in trouble for a while.
Yeah, for sure. So we've seen real wages, so wages have been outpacing inflation for some time, especially on the lower income side. That was very important, I think, in terms of even, you saw sort of the disparities narrow, and that could, especially if the labor market slows, that could sort of be turned back to, maybe not all the way back, but go in the undesirable direction again, yeah. And that's part of that's part of the worries about, want to keep this labor market from really sliding. Right. Yeah.
I guess my question would be perhaps primarily directed to Willem, but can you, one topic that hasn't been injected into this conversation, and I don't know how relevant it is in terms of a 2-year time frame forward, but in the years to come, could you speak to the issue of what the impacts of servicing our public debt in this country, which is now costing, it's about $1 trillion a year in our federal budget simply to service the debt, which is more of a concern, I understand, than the actual total amount of debt. It's its part in our current budget. But can you talk for a minute about, from the Fed's perspective, about in a worst case scenario, if China were to begin to, on a policy basis, begin to slowly dump the treasuries that they own, and Japan for some reason, if other major holders of our debt began to ratchet down their holdings, what impact would that have on this discussion? And also, let's assume that AI disappoints in a big way, and we don't have the kind of productivity gains that we're counting on from AI. You know, how does that impact our ability to service this debt, and how does it begin to impact the labor market and so forth, and inflation rates? I know it's a large question, but
It's a big topic, and I think so. Maybe aside from monetary policy, so I guess first thing comes to mind is this. So we have the country has a very large debt. So there could be issues like, or maybe it's like foreign bondholders could change their purchase, but there could be other reasons where investors might just at some point decide that I don't see the end game. I don't see how they're gonna end up paying me back. So that could, what you would expect to see is an increase in those bond rates, the yields, which are now about 4% for a 10-year. I guess nobody knows really how this is going to play out. It's maybe surprising why these rates are only 4%. So there's plenty of buyers still. But you can see that I guess that people would need to see to sort of get out of to get a control over this. The fiscal issue is some combination of reforms, maybe lower expenditure, higher taxes, and then the other solution or another way to reduce the debt burden is, as I said, is kind of through inflation. So the inflation of the last few years, the one, if there's a positive about it, is that the debt to GDP ratio came down from that. But I think that's not really a solution. That can sort of erode, inflation surprise can erode what you've accumulated in the past, but a lot of our overspendings over what we collect in taxes is indexed. And so you don't even, the only way to get out of that is to reform those spending programs and what you take, you kind of try to balance what you take in. And the role of monetary policy is really, I think it's not a big role there. I don't think you can say, oh, if investors get worried and treasury yields go up, that the Fed can somehow keep those rates from going up.
in that case, the Fed would become potentially a much larger holder of treasuries than they currently are. to offset that?
Yeah.
Yeah.
Yes, I don't want to speculate too much. Maybe others on the panel are more free to speculate.
Yeah, I was just going to jump in, and I didn't have time to really talk about this in my presentation, but a lot of macroeconomists have started to think about the dollar depreciation, because as I mentioned earlier, normally in an open market economy with flexible exchange rates, if you raise tariffs, you typically expect to see an appreciation of the currency. We did see that. The empirical research shows that the dollar did appreciate 2018, 2019, and the Chinese currency actually depreciated, and that was precisely what the traditional, hopefully some of you students have learnt your ISLM model properly in your macro classes. I know the professors over here. But the pressure on the dollar this time round has not just been, the pressure is partly because of retaliation, but also because if you go back and look at what happened in April, May, a lot of people, foreign investors, did start to dump US treasuries, and we saw this big spike in yields on both 10-year and 30-year treasuries. And so a lot of macroeconomists are starting to think about, I think it was President Valéry Giscard d'Estaing called America's position as having the vehicle currency, the global currency in which most commodities are traded in dollars, that this was an exorbitant privilege allowed to the United States, and that if the dollar does remain where it hasn't depreciated that much, but if there's continued pressure related to this debt issue and maybe a continuing trade war, that this, what we could lose here in the US, and this is based on a study that was presented recently at the Brookings Institute, and it'll be coming out in one of their journals in the next few months. You'll see right now we have low yields or relatively low yields. You'll see an increase in those yields because of this discussion we've just been having. But that means the relatively lower borrowing costs that American firms face relative to other competitors around the world, those borrowing costs would also increase. And maybe this is partly related to the discussion we just had. We would attract less investment here to the United States. And this study was really kind of interesting. They actually calculated at what rate of depreciation of the dollar might the euro become the vehicle currency. There's been this debate about whether the euro could become an alternative to the dollar, but there's much more serious discussion amongst macroeconomists now since the tariff effect has pushed through into the dollar. So that if I'd had time, I would have talked about that in more detail. It relates partially to your question and also to Willem's response to your question.
My question is really in regards to wealth distribution and the effects of the economy to the U.S. economy and Central Ohio in particular. What your thoughts are in regards to wealth distribution. Over the last 75 years, the middle class has been a strength of the U.S. and our economy, and we're seeing a pretty diverse wealth distribution happening today. What are your thoughts in regards to that?
Oh my God, this is a major soapbox topic for me, and honestly, I didn't prompt Brad for this. Beginning about 1980, well, before 1980, productivity was going like this. Wages were going like this. But about 1980, it broke. The relationship broke. Wage growth was flat, and productivity continued to increase. So where did those productivity gains go? They went to the upper class. And you can see, if you chart out, as Willem did over a shorter term, over the longer term, you can see the gap growing bigger and bigger and bigger. And the problem then becomes that lower income households don't have the money to spend on goods and services, and so it costs our economy. The upper income people are saving a lot of their income, and so it's not going to consumption. And so that has to have negatively affected GDP growth. But yeah, there's a book by Kurt Anderson, Evil Geniuses, worth reading. It talks about all this wealth redistribution and in no uncertain terms talks about its impacts.
I'll give you my, as a trade economist perspective. Paul Krugman has a great article that he went back and thought about a paper he'd given in 2000, again at the Brookings Institute, where most of the people presenting papers there were saying that international trade had not had that much effect on wages here in the United States, in the sense that emerging economies were not undermining wages. But then 10 years later, after the China import shock, that up to the financial crisis, we now know that the impact of that shock, so China joined the WTO in 2001, and I don't know how many people in the room know this, but our imports from China over maybe a 15-year period grew by nearly 1,200%. And our exports to China only grew by about 400%, and our imports from other developing countries only grew by about 300 to 400%. So there was this huge shock to the manufacturing sector, not all over the United States. I mean, obviously the Rust Belt here in Ohio had begun before the China import shock, but it had a significant impact on certain industries in certain states. And many of the people who lost those jobs, their mobility was really low. And so I think we can pinpoint that China import shock as being when the social contract in the United States over globalization was sort of broken, where prior to that, trade with developed countries hadn't really hurt job growth in this country. Most job loss in this country in manufacturing was due to technological change, or productivity growth. So if you look at the percentage of employment in the United States from the post-war period through to where we are now, we're down to about 10% of total employment is in manufacturing, and most of that is due to technological change. But the China import shock did actually lead to a significant impact on job losses in the United States. And the move to anti-free trade, protectionism, and sort of nationalist or populist economic policies really grew post-China import shock. And there's a lot of evidence that, surprisingly, that if you look at the Brexit vote in the United Kingdom, by the way, Brexit is extraordinarily painful for me as a Brit to talk about, but if you look at the data, the voting areas that saw the largest vote in favor of Brexit were actually the ones most affected by the China import shock to the UK economy, because if you look at the share of... So I think that shock has done a lot to affect the wealth distribution, and that those of us in, say, the 90th percentile of the income distribution have done well out of globalization. Smaller proportions of our income are spent on goods. We spend much more on non-traded goods like services. And so I think, backing up what Bill was saying, but from a trade perspective, and the social safety net here in the United States is nowhere near as good as it is in parts of Europe. We had something called the Trade Adjustment Assistance Scheme, which was implemented by during the Kennedy administration and prior to the Kennedy round of trade negotiations in the old GATT in the mid-1960s. But basically that system has never been really upgraded. Increased money has never been put in it. It never really covered white-collar workers who lost their jobs in the early 2000s when jobs were being exported to, jobs exported in inverted commas, to Mumbai. You think about computer engineers lost their jobs because computer engineer wages were considerably lower in India. And that social safety net has never really been underwritten by Congress in any meaningful way. So economists, we teach our undergrads that when we evaluate policy, we want to look for positive net benefits. And I think the evidence, and maybe Willem I'm certain would agree with me, that the net benefits of globalization have been positive. But the winners, we haven't done a very good job at compensating the losers, and I think that's the way I would think about addressing your question.
Yeah.
And if I can add, and this is kind of maybe sidestepping a little bit the question, but in a room full of young people, I do want to also emphasize that the remarkable thing of the US economy is that GDP is just like, it just goes through whatever events you look in history, GDP just keeps going up. And that is, so the pie keeps growing, the opportunities keep increasing. And it's true that inequality has also increased, and you see this split in the 80s, but it's no small feat, also speaking as a foreigner, to have such a dynamic economy which is full of opportunities. Another thing I want to add, and this is also not really my area, but so a big part of the affordability issue, I think, is in housing, and that is about more than lowering interest rates. I think it's really kind of on the supply side. There's a lot of issues, and there's structural issues. But the way I look at it, these are not insurmountable issues. This is not like the public debt. This is something about local regulations and kind of like if there's enough people coming together, agreeing on the solution, these solutions are there, I think. So this is something about a big part of this affordability problem is more about the will than really, the will to tackle it than really some kind of deep pressures. So kind of trying to give it a little bit of more, add some optimism.
Quick question for Bill.
Yo.
Bill, I think you and I both agree the Columbus MSA is a great place to live.
Yeah.
We got a room full of 18 to 22-year-olds that might feel similarly, might be thinking about starting a career in Columbus. Looking at your population data, it's the first time I've seen something like that, and got me thinking, if you were a young person thinking about where you're going to start a career, where you're going to live, do you look at that data more as a warning about declines in certain industries in the Columbus market, or as an opportunity that we're going to have maybe less competition, higher wages in certain types of occupations due to a greater need for nurses and other types of high demand occupations?
I would think more the latter, and I definitely agree. The Columbus area is a wonderful place to live, it really is. And I spent some time up here, maybe scaring y'all just a little bit, but let me just say that I got an MBA in finance from Wright State in 1981. And if you remember your economic history, 1981 was not a particularly favorable time to graduate with an MBA in finance. But what you have to do is you have to think about your skills in a holistic way. You have to look at your training, look at your experience, look at what drives you, what is your passion, and maybe go in a very different direction from what you were originally thinking. I was wanting to take on Wall Street. I wound up teaching at Ashland College, and it changed my life. So think about your skills. Think about what you can offer in a more whole way. And something may happen that you never expected. But it's like I said in my last sentence, you'll be fine.
I think we have like one brief question, and if anybody has.
I have a brief question for Willem. Not for us older people in the crowd, but I see a lot of young heads here. We see this item called acceptable 2% inflation. Why is it not 1 or 3? Why is it 2?
Yeah, that's a good question, because obviously, I know I'm not 2.1 or 1.9. But so the Federal Reserve came down to this number 2, and I think there's several issues. So I guess when the Congress mandates price stability, so literally that would mean 0, just keep the price level where it was. And the reason why the Fed interprets it as, well, a little bit more than 0 is probably better than 2% is the number that came down with, is that there might, so there's several reasons. One is that there might be some measurement error. So actually when you measure 2%, what's actually going on because of quality changes and the difficulties in measuring prices, it might actually be lower than 2%. But then there's also, so even if we measure things perfectly, there's some asymmetries in the economy that make it a little bit easier to have positive inflation. So one is that wages, so what we see is wages almost never decline. So your boss is not going to give you a wage cut, they rather just let you go because of the morale or whatever the reason is. So you can actually have wages adjust down in real terms by having a little bit of inflation to grease the wheels of the economy, is what people say. And then the other thing is the zero lower bound on interest rates. So the Fed interest rates will be higher because inflation, on long run inflation is 2% versus when it would be 0. And so when interest rates are higher on average, you have a little bit more room to cut them when the need arises, when the economy slows down. So those are some reasons why too. And so why not for that? So this debate, it's not really an active debate, but I think what really the policymakers want to go for is that inflation is low enough that it's just on nobody's mind. So it's not something that you would have to factor in seriously when you're making your plans, your kind of personal finance or your future investment plans, whatever. Yeah. So that's the number that they came up with, or came down on.
Well, thank you all for coming. I'm going to contradict Bill, and I'm going to say that all three panelists delivered presentations that were both timely and reliable. It wasn't either or. So as students sitting here, you've heard many things today, and hopefully you can connect the part, and whenever somebody speaks about their field, try to soak it up. I mean, today, an economist was talking about technical details such as soybean corn rotation and how it matters on distribution and what's going on and how it impacts Ohio farmers. That inflation does not only inflict pain but also causes redistribution, something like a K-shaped economy. I was very glad to hear, which I believe, and especially in the macroeconomic sense, macroeconomists, I believe, have not paid enough attention to income distribution and an impact in their modeling on what goes on the economy. So I'm very happy to hear that all three, both Willem, Ian, and Bill, talked about wealth distribution, especially shared growth, and the importance, realizing the importance of shared growth on the overall economy, and affordability and so on. So I thank you for coming. Thank you for great presentations, and you're welcome to come to the same panel in the future. I hope to see you here. Thank you, the audience. Have a good evening.